Hello viewers, this is Ayush Vardhan and I welcome you all to this video of Introduction to Accounting. Today I am very thankful to Antara that she has motivated me and she has given me a chance to do this video and let you all be benefited with it. So let me tell you about myself. My name is Ayush Vardhan, as you all know, and I have done the general management from IIM Bangalore, and currently I work for Network 18 Media and Investment Private Limited, and I have done my graduation in 2014 in Electronics and Communication branch. So this is my introduction, and my area of interest are marketing and operation research, accounts, and all. Along with I have some interest in telecommunications because I have started my career from telecommunications, and media development is something what I like and what where I do work. So these are some area of interest what are really good and where you can be like where you can enhance your skills and make career. So these are my contact details where you can contact me for any guidance and any queries or any video related issue, any content related issue. So you can contact me via LinkedIn, via Facebook, or you can contact me on my email address that's given here. It's ayushvrdhn@gmail.com. So now I think we should start with this video. Here I will start with some introduction and definitions of terms related to accounting and what accounting is actually. So, the first thing that comes in our mind related to accounting is bookkeeping. Bookkeeping is the art of keeping a permanent record of business transactions is bookkeeping. Okay. So, in bookkeeping, what we do, we record all the data, all the business transactions. So, that is a process. That process is called bookkeeping. Okay. So, and accounting for accounting, bookkeeping is a foundation. On the basis of this bookkeeping, the entries or the records made by bookkeeping process, we do accounting. Accounting has some broader scope, so this can be the definition. One of the definition of accounting that accounting is a process of summarizing the financial performances of any organization in an easily readable and understandable understandable form. That is, any accounting book is like what we do in accounting. We summarize all the business transactions. Those are in monetary terms, and then we uh, maintain in such a way that we can easily read all those. Anyone can read those. Anyone can be benefited with those uh, entries, and they can easily understand all those. They don't need to go through specific education purpose, educational way to get the knowledge of reading, just reading the business transactions that those have been entered or recorded in a accounting book. So there are some different international organizations who have given their definitions. One is American Institute of Certified Public Accounts, abbreviated as AICPA, has given their definition in 1941. They have defined the accounting as a way of recording, classifying, summarizing, analyzing, and interpreting the business transactions systematically and communicating business results to interested users. Okay, so they have specified with some specific users and for with that concern, the business transactions are classified in different categories. Then all those are summarized, all those categories are summarized, all records of those categories are summarized. Then analysis and interpretation on the basis of those records which have been classified and summarized happens. Okay, so this happens in a very systematically way, in a very systematical way. So they have focused on the systematic word here in this definition. And another focus area is communicating. So this accounting data or accounting transaction record has to be communicated with different levels of users. Those users can be the internal users of the organization, like in an organization, in any company, uh, the different account persons or the owner of the company or the CEO of the company, they require those data along with all those person like investors who are not the part of the company or the organization. They also require those accounting data for their own sake. They have different purposes. So this is how the communication is very important. So all the records should be in a systematic way so that it can be communicated easily. So now again, American Accounting Association also has given their definitions as well. They have also focused on the same area, but what they did, they have specified the boundary. On that, within that boundary, you have to record, you have to identify, you have to measure, you have to record the business transactions, and then communicate all those things within that boundary and uh, across that boundaries. Okay, so the interested users are everywhere. So within that boundary or outside of that boundary. So what they have given is accounting as the process of identifying, measuring, recording, communicating the required information related to economic event of an organization to the interested users of such information. Okay, I hope these both are the definitions. These both definitions have been cleared, and these two are the basic definitions given by some renowned organizations related to accountancy and finance. Okay, now we will see uh, the a few economic events. So what are the economic events? All those events within the organization which can be termed in monetary way, like which has some cost associated with those, like purchase of machinery. We spend some particular amount uh, for purchasing, so that is a monetary event or economic event. Okay. Then installing and keeping it ready for manufacturing. We have purchased a machine for our factory and we want uh, it to be installed and keeping it ready for manufacturing. So that happens and that requires some more money. So again, that is economic event. So an economic event which consists of number of financial transactions. Simply those transactions which can be represented in financial terms. So for each and every event, we try to know it's economic event or not. So then we can make the entry into the bookkeeping. So for that process of entry in bookkeeping is divided into 5 parts. The first process is identification. Okay, the identification implies determining what transactions are to be recorded, like purchase of machinery. Purchase of machinery is something where cost is associated. So we have identified cost associated. Again, we will enter that. Okay, so it can happen on cash and credit both. Like with some sometimes what happens is you don't pay immediately for any purchase. You postpone the payment. So that's the credit way. And measurement is again. means qualification of any the way it's a measurement is something basic of identification, you can say. So measurement gives you an idea that any event is qualified for business transaction or not, qualified as business transaction or not. Okay, so there is example that's change of CEO and the change in salary of CEO. That change in CEO is something one person is replacing another person that is successor of that post. So this is not monetary. Here one person replacing another person. Okay, it's very simple to that. But the salary of CEO has been increased, suppose. So this is something that comes under the monetary term. So this will be something that has to be recorded. So another process is recording. Recording is having identified and measured in economic event in financial terms. These are recorded in the books of accounts in monetary terms and date wise. So we have identified and measured the terms that this has to be recorded or not. So then we will make the record, but we will make the record date wise. That's very important. Then what we do it for the communication purpose. We have been talked about it, like who did the data related to business transactions or the related to economic events. Then where we will do it? We will do it within the organization that AAA, American Accounting Association, has given the boundary. That the organization refers to business enterprises where the profit, those business enterprises could be profit or non-profit, both. Okay, non-profit like NGO, profit like any company or any government organization as well. Those are meant for profit. So then we do bookkeeping while keeping in mind the interested users of the information. Whatever information we are entering, we always being very particular, uh, very what we say that we have to keep in mind that who are the interested users of those information. So we have to focus on that. So those users could be investors, creditors, labor unions, trade associations, government, tech for the taxation purpose. So we have to be very focused on who are the interested users of that information. Now, uh, what are the difference between bookkeeping and accounting? So we will define some basis on which we will see what are the differences. So first basis is the nature. What is the nature of bookkeeping and what is nature of accounting? So in the bookkeeping, it is concerned with identifying financial transactions, measuring them in monetary terms, recording and classifying them. Means what we do in bookkeeping, we identify the financial transaction. Is these transactions are financial in nature or not? Then we note them down and classify them uh, to the category from which they belong. Then next is accounting. Uh, Accounting is concerned with summarizing the records, recorded transactions, interpreting them, and communicating the results. What happens? We do in bookkeeping that we identify the financial transaction, measure them in monetary terms, then we record them and classify them. Then what we do in the accounting, after bookkeeping, we do accounting. In accounting, we summarize all those bookkeeping records and for the further interpretation, what are the use of them. Then we also interpret them for in a specific way so that we can communicate them with the interested users. Then what are the objectives? We differentiate on the basis of the objectives. So the bookkeeping has limited objectives. It is to maintain the systematic record of financial transactions, but accounting had some broader objectives. like it aims in ascertaining business incomes and financial positions by maintaining records of business transactions. So here, what are the objectives of accounting? The objective of accounting is here we want to know the financial position of the organization. So this is a very basic objective on the basis of which we maintain the records of accounting. So, and we also maintain the record on the basis of business income. So whatever income has been done. So it is one of the basic objectives we want to know through the accounting. Then what are the functions related to both? The function related to both related to bookkeeping first is only recording the business transaction. This has very basic function recording. So we have to very attentive when recording. All the recording entries should be correct because this is the very basic on which we do accounting. Okay, so when we record the data, then we classify them, summarize them, we do interpretation of them, and then we do communicate. So the functions related to accounting are recording is the first, classifying is the second, summarizing is the third, interpretation, the business transaction is the fourth, and the last is fifth is communicating the result. These are the five functions of any business accounting. Okay, then the knowledge associated with bookkeeping and accounting are we have limited functions, so limited knowledge. We have elementary knowledge related to only the transactions only, but in bookkeeping, but in accounting we have detailed or vast knowledge because there are different kind of functions related to accounting. So each function provides a certain knowledge or a specific kind of knowledge. So accounting holds a good amount of knowledge in it. Okay, and then there is some relation. The relation is that bookkeeping is the very first step, as I have told. So, but this is the foundation of accounting on the basis of which we made our whole accounting thing. Okay. So this is a very basic difference between bookkeeping and accounting, and I hope all these are clear to you. These differences happens on the basis of nature, objective, function, knowledge, and relation. Okay. Now next is a few types of accounting. So first is I will start with financial accounting. Financial accounting is concerned with recording the transactions of financial character, summarizing and interpreting them, and communicating the results to users. So these are the basic things. Like we summarize all the financial records. Okay, we interpret them as per the user's requirement. So it is why do we do financial accounting? So this is for the very basic purpose of uh, calculating the profit and loss calculation, and this calculation happens generally for an accounting year. That's the one of financial years. In India, financial year is from April to March. Like we say financial years 1920, that is April 2019 to March 2020. Okay, so financial accounting also provide the financial information required by other parties for the management. Okay. Next is cost accounting. In the cost accounting, we analyze the expenditures so that to ascertain the cost of various products manufactured by the firms and fix the prices. What happens? Suppose the, we are the company. We have expend 50 rupees for buying something raw material. Okay, and then we have spent 10 rupees more on the process of those. So this is how what happens is uh, this is how what happens is we calculate the total cost related. So this is 50 rupees for buying raw materials, 10 rupees for processing, that is 60 rupees. So this is how we analyze our expenditure for any particular uh, process, okay, or like operation process. Then according to that, we define what should be the prices. So this is the basic of cost accounting. So it helps in controlling the cost and provided necessary costing information to management for decision making purposes. Then we have management accounting. So it is concerned with gathering information related to funds, cost and profit, etc. So this is basically for the decision making on the basis of financial accounting. We do management accounting. Financial accounting is the basis of management accounting. So management accounting is basically to assist management in taking a rational policy decision and to evaluate the impact of its decision and actions and the performance of the various departments. Okay. So on the basis of management accounting, what happens is we implement any decisions or any new policy, and we evaluate the performances of the various departments, the performance of the sales department, performance of the accountancy department, performance of the marketing department, and etc. Okay. Now, the another term we have is the tax accounting. In the tax accounting, what we do that each and every company or an individual has to pay tax once in a year. So we do the calculation related to tax. This branch of accountancy has growth in response to the difficult tax laws such as related to income tax, sales tax, etc. So in the tax accounting, we deal with all these terms. So this is one of the very important thing that every organization and individual has to do. Then we have social accounting. Social accounting is also known as social reporting or social responsibility accounting. In this, uh, matlab, in this we deal with the social benefits created and the cost incurred by the enterprises. So, what kind of social benefits we provide within the enterprises? Those are like medical facilities, housing facilities, education facility for the employee and their wards, canteen facility, free foods for the employee, PF for the employee. All those are calculated or measured. All these business all these are termed in monetary ways, can be termed in monetary ways, but these things come under the social accounting. Then we have human resource accounting. It is concerned with human resource of an enterprise. So human resource, who are the human resource? Human resource are the employee of any organization, and this account calculates the value of your human resource. That what is the value? Value is salary that you draw from the organization. Okay. Then we have national resource accounting. This is specifically not concerned with any specific industry. It is related to nation as a whole. The resource that nation has, how much mining capacity we have, how much workforce a country has, how much natural resources like forest, water, etc. The nation has, on the basis of which we calculate the GDP of the country generally. So these are for economic purposes. So and this is for GDP calculation, and economists use these things. So it is generally not concerned with any accounting of individual business entities, and it is not based on general accepted accounting principles. We have already discussed these. So next thing we have is some main objectives of financial accounting. So objectives are things. So why we do any financial accounting? What is the main purpose of it? So the basic objective of it is finding out various balances. So We have the account sheet where we see what are the profit, what is the loss, how much equity we have, how much liability we have. So all these, we all the balances related to all these is one of the objectives. That's why we do the financial accounting. Next is providing knowledge of the transaction. Like we have made certain transactions over the year, so we should have knowledge of each and every transaction. So financial accounting is very required. So how much profit and how much loss we have gained. So for that we also do the financial accounting, and the financial position on the basis of profit and loss. We depict the financial position of the company or any department while comparing with the competitors. So this is how we depict the financial position of any company. Then we have information to all interested users. So we communicate, we have been talking about that we communicate the accounting information. So with whom we communicate? We communicate with the interested users. So we have to do financial accounting. Then we pay the taxation and all. So taxations are the legal obligations that any organization or individual has to do. So we have to do financial accounting. So these are the five basic objectives why we do the financial accounting. So next is the functions of financial accounting. So functions of financial accounting is to provide quantitative information or primary financial quantitative information of all the business transactions which are primarily financial in nature uh, and which has to be entered in the accounting book. Okay, so these are ultimately leading the decision making process. So basic functions related to accounting are maintaining systematic records. We have to maintain the systematic records so that we can get the fruitful output of it, meaningful output. Then we communicating the financial results. This is another function where we communicate the financial results with different persons, the different level of hierarchy in any organization or outside the organization. We meet the legal requirement. So for taxation and all, we have to do the accounting. This is another function. Then fixing responsibilities, like what are responsibilities of which department, uh, like what is the how much sales that we have to do, how much revenue we have to generate. So these are all the responsibilities that we fix on the basis of accounting. So this is another function of accounting, and this function ultimately leads to another function, that is the decision making. So fixing responsibility is actually an example of decision making. There are certain another decision making, like there are another department which are related to daily operations of any organization, like department related to uh, like in an IT organization, department related to, you say, programming. They don't generate the revenue. So we have to make the decision how much should be capacity of those, and all those have the function of accounting. Okay. Then we have certain limitations with accounting as well. Those limitations are the very first and most important limitation is in accounting we make the entry related to term which can be expressed in monetary term. Like I have given the example of change of CEO and the change in the salary of CEO. So only change in salary of CEO is the information that can be expressed in the accounting purpose. Okay, and then the fixed assets are recorded in the accounting records at the original cost. We will talk it later. Uh, uh, Accounting information is sometimes based on estimates. Okay, what happens? We have made a sale in February month. Okay, and the thing is, it is on credit basis, and we will be paid in the month of June. of this amount. Okay, so we have made the assumptions that we will be paid in the June, and the amount we will pay is 10 rupees. So we have made the assumptions that we will be paid in 10 rupees in the June. It might be that 8 rupees in the June and 2 rupees in the July. So we make the assumptions, and on the basis of these assumptions, we made an entry on this accounting year that has to be ended in the March. Okay, so we make the information based on estimation sometimes. Okay? Then accounting information cannot be used as the only test of managerial performance on the basis of merit profiles. Like there are some other things on which we make the decisions or we measure the performance of the department. Those are not only accounting, so we have to keep in mind. So this is the limitations. The decision making things are broader. So accounting is one of the part of those. Okay. So accounting has another limitation, that is it is very unbiased in nature. Like accounting is a number, and number never tells lie. So you can never say we are getting profit while number are not showing it. So these are two functions and limitations of the accounting we have covered. Now next is few accounting terms we will cover. The very first term is business entity. Business entity means a specific identifiable business enterprises. Any enterprises which are concerned with uh, doing business, like shop, a simple shop, nearby shop, or any mall or big bazaar like big shopping centers, or Gale India Limited like government agencies, or Aaj a new channel, Parle, a manufacturing sector, a biscuit manufacturer. All these are business entity. Business entity has a concept that the owner of business is someone and the business is something different. These are two different identities. This is the owner, this is the business. One owner has two or three businesses. So all those will be different. So the business identity has something very specific concept, that is business owner is different from business. Then we have transactions. Uh, Transactions are the event which involves exchange of some value between two or more entities. Like we purchase something, so we get a bill, that is purchase transaction. Getting selling is a transaction. So the transactions can be happen on cash transaction or credit transaction, that you are immediate getting that cash for any transaction, or the cash will be paid at later stages. Okay. Then after transaction we have purchase. Purchase is something procurement or the buying. The term is used for goods or services to be dealt in. So for a business prospect, what we see is we do purchase. We do purchase for two purposes. One is resale, another is for redevelopment of the goods, like reproducing of the goods. Like there is a shop who buy some items from wholesaler for reselling purpose. Okay, and there's a factory who buy something from someone for reproduction, like they buy raw plastic for making plastic toys. Okay, so again the purchase can be happen on cash and credit both way. And then creditors. Creditors are the person who have to be paid by an enterprises an amount for providing goods and services on credit. So creditors are someone who has to be paid by the organization. Like there is a wholesaler who has to be paid by the shopkeeper, because shopkeeper buys something from the wholesaler. So shopkeeper is, as an organization, has to pay to wholesaler. Okay. After that, there is sales. Sales is the total revenue from good or services provided to customer. That shopkeeper is selling something to customer, and the total amount they get, that is the sales, or the total amount is termed as revenue. Okay, and again sales could be cash and credit both. Then debitors. Debitors are the person who has to pay to the organization. Like customer has to pay to shopkeeper. Okay, so customers are the debitors, and debitors examples are the trade debitors and account receivables. And we will see it in the deep. What are the trade debitors and account receivables? Okay, later. So now some a few more terms on is revenue. We have talked about sales. The total sales value is revenue. So for banking, revenue could be interest that they get from loan given, and royalties for the writers that they get from the publishers. Rent when you lease out something, you get the money for on monthly or yearly basis. So those are the rent. Those are the form of revenue. Revenue is termed as the income of any enterprises. Then expense. Expense is the cost incurred by business in the process of earning revenue. Is called expense. Like we are paying some rent, we are paying salaries, we are paying interest to bank. But why are we doing this? We are doing this to do business, and by that business we can get something. We can get some revenue. Okay, so for getting that revenue, whatever payment or whatever cost is associated, that is the expense. Okay, so income is the difference between revenue and expense. Then we have gain. Gain is generally termed as the profit. Example could be a capital gain, but gain is not actually the profit that has earned by a company. The profit is something that is the net profit. Net profit is after paying all the taxations and dividends, taxes. Then we get the net profit of the company. Okay, the profit is the exchange of revenue of a business over its cost. So that is something expense minus revenue minus expense. But then we have loss. Loss means the transactions against which we or the firms have received no benefits, where the expense is greater than the revenue. In the simple term, it can be said. Now we have expenditures. Expenditures are usually the amount spent for the purchase of asset, like the any firm pay rent, they pay the salary. So these are the examples of expenditure that the organization has made. So if the benefit of expenditure is exhausted within a year, it is treated as revenue expenditures. That is uh, like the benefit what we get from that expenditure, and all those benefits if we spend within the year, like we are paying salary. Okay, so we are making expenditure. So what is the benefit from salary? The work done by employee for getting for generating revenue, and that revenue is suppose spent within the year, then that is the revenue expenditure. Okay, if that is not spent within the year, and some revenue is transferred to next year, then that's the capital expenditure. That is a form of profit. Then drawing. When we were talking about the business entity, the owner is different, the business is different. So the owner is taking out something from the business, that's a drawing. Then capital is the amount invested by the enterprise in an enterprise by its owner, like business owner and business. The owner is paying something to business. Okay. Now owner has paid or started a business with some investment. So for the business has separate uh, identity. So it has been started by its owner by some investment. So that investment is something is liability for the business, because it's not the capital or profit of the business, it's something related to its owner. Okay, that's why it is being told that any amount contributed by the owner towards the business unit is a liability to the business enterprises. Another term is asset. Asset can be tangible and non-tangible. Asset are those uh, uh, on the basis of which we do the business. Like we have machines that are used for the production, so that is the asset. That asset is tangible. We have a space where we have installed the factory, so that is an asset. That is a tangible asset. We can see those. But again, we have some intangible. Intangibles could be the patent rights and copyrights. No one other can produce the same thing. That's the patent right. No one can publish the same content. That's the copyright. Then another thing is current asset. Current asset are the assets those are held for a shorter period of time, generally 1 year of time. So something, some asset, those have to be exhausted at the end of year. That those can be treated as current assets. And they are fixed assets. Fixed assets are like machine. Machine is something that has to be used year and after year and after year on the basis. So those are the fixed assets. After that, we have the liability. Liability is something that a company or an organization has to pay back to its owner. As the owner funds, the when we were talking about the capital, stock value, vouchers and discounts, those are the liabilities that anyone has to pay. Yeah. Then we have accounting concepts. Accounting concepts are the assumptions or the rules or the principles on the basis of which we do our business. So we do the recording of the transactions. So these are the 9 assumptions on which we do on which we do the accounting or we record the business transactions. Okay. These are business entity concept and money measurement concept, going concern concept, accounting period concept. We will see the all these 9s in the detail. So first is business entity concept. We have talked about it. In the business entity concept, we see business and the owner as two individuals. Here in the picture, you can see in the upper part, this is the personal asset of any individual, and these are related to their business, like employee and inventories and all. Okay, and in this, you can say the owner half his business and half himself, herself. Now, money measurement concept. Money measurement concept is something where we think in a way that all business transactions is to be happen in terms of money only, so that we can make the easy uh, entries for that in the accounting process. This concept guides accountants what to record and what not to record. So on the basis if those are in monetary terms, then we know we have to record it, and um, those are in monetary terms. So it is very easy to understand the accounts, and we can compare that those entries of account with the competitors and or our self last year records. Then we have going concern concept. In the going concern concept, it is given that any businesses for everlasting. Like if business has been started, it is never going to be ended. So on this basis, we do the business, and this is very important for the depreciation charging and especially for the fixed asset. We charge the depreciation for the fixed asset. Okay. Then we have accounting period concept. In the accounting period concept, we- what we have is we know the business is for infinite time. So we need to actually know what is the profit, what is the loss, or what is the actual standing of the business. So that everlasting time has been divided in specific periods, or generally, generally those periods are like 1 year period or the financial year period, where we can easily predict the profit loss and etc., the sale records, and on the basis of which we measure the uh, profit and losses, and we pay taxes. For taxation and profit loss calculation, this accounting period concept is very important. Okay. Now, accounting cost concept. In the accounting cost concept, what happens is cost concept states that all assets are recorded in the books of accounts at their purchase price, which include a cost of acquisition, transportation, and installation, and not at the market price. This is also called historical cost concept. Like we have bought some fixed asset, as you can see in the picture, that price of fixed asset at the time of purchase. So what we do, like we have made the entry for the machine for the production. Okay, so the entry for that machine happened once is 100 rupees, suppose. So in the next year that will be 100 rupees. That will not be based on the depreciation of its cost. Like suppose I'm giving you a general example. You have bought a laptop or a mobile phone cost 20,000, and after 2 years you see the price of same model has now been reduced to 15,000. That doesn't mean the price of your asset has been 15,000. Your asset is still of 20,000. Our depreciation happened there, but we do the accounting on the basis of the historical price. What was the price at the time of purchase? Okay. So when we see in the business scenario, we also include the transportation cost of the machine related when we buy it, when we transport it to our own place, and then cost related to installation and all. Okay. Further, it may be clarified that cost means original or acquisition cost of only for the assets. So it's basically for the asset or fixed asset. So this is done for the depreciation calculation of the asset. So this very important. When you want to shut down something, you want to shut down and you want to sell out the things. Okay, and at that time you calculate the depreciation, and after calculate depreciation, yeah, you come to know what the actual standing of your organization. Then we have dual aspect concept. It's one of the very basic concept where what we see, we made entry at two places for each and everything. And the next slide, I will give you the detail that for the concept is for every debit there is a credit. So let's see, like we have an example that we are giving cash for receiving goods. So we will make the entry for giving cash and receiving the goods. So here is the example. The this example is double entry bookkeeping system. This is the this figure depicts the double entry bookkeeping system where one side, this side, LHS, their assets are leveled, and this side liability and equity are leveled. Equity can be further divided into like revenue and expense along with the equity, that is the share capital. Okay, and so suppose in a business that has been started with initial value of 40 lakh that the business entity owner has provided to the company, to the organization. So we made the entry at the both sides. So these LHS and RHS should always be equal. Okay, so when we make some payments, okay, like salary, rent, we make the entry at the both sides. We have purchased the inventory like furniture and all, so we made the entry -5 +5. So this is how we make the balance. That's the concept of dual aspect concept, where we make the dual entry of a anything. Okay. Then we have realization concept. Realization concept tells that the revenue can only be realized once the underlying goods or service associated with the revenue has been delivered. What is that? I'm giving you an example that a customer is paying $1 lakh for any product. Okay, so what happens with product, that product has some life, and for that life, for certain time they provide some uh, warranty or guarantee things for the asset. Like you buy a computer for 1 lakh rupees, and what happens, that cost of computer is only 80,000 rupees, and 20,000 rupees is associated with its warranty that company spends on providing the warranty. So company realizes the 80,000 rupees immediately once the purchase, once the sale has been made, once the transaction happened. But when the company realizes that 20,000 is realized once the warranty period has been ended. So the 20,000 rupees is not realized at the time of immediate sales or immediate transaction. So that 20,000 is realized at the later stage. Sorry. Okay. So here revenue is recognized by the seller when it is earned. So here it is earned immediate, that the value of immediate realization, and that is the later realization, that is we gradually realize. So whether it is earned irrespective of whether cash from the transaction is in advance or receivable. Like sometimes you buy a computer from a shop and shopkeeper is someone in is your known, and you say that okay, I am paying you later. You give me the computer, I am paying you the later, or you pay the 50% in advance and 50% you say I will pay you in the monthly installment. Okay, so these things doesn't matter at that place. When realization happens, they realize depends how they provide the service. Okay, now the accrual concept. This is one of the most basic concept of any business scenario, or especially for the uh, accounting purposes. This tells the revenue when it is earned, or cash may be received or may not be received. So when we realize the revenue, like you are buying something from a shopkeeper. Okay, so what is work performed as a shopkeeper? That goods sold. Okay, the shopkeeper has sold a book to you, so they realize the revenue at that time. It doesn't depend you are paying the money immediately to shopkeeper or not. So it doesn't matter. It might be that you are paying at a later stage, but what happens is uh, shopkeepers immediately realizes that revenue has been generated. Okay. Next, expense when it has occurred, not when it is being paid. Like a company uh, sometimes happens with in any company that what they do, they ask some expert, okay, they take their services, but they are not paying them immediately. They pay them at a later. As the contract, the contract is written that we will pay you back in 3 months, okay, or we will pay you in the installments. But here, what happens is uh, the expense is made immediately. uh, com- Company realizes that expense has happened. However, they are not paying immediate, but expense has happened. So this is the accrual concept where it is given then when we have to realize the revenue and when we have to realize the expense. So it has been knowing the actual expense and actual income during a particular time period. So because we know the actual time of revenue and actual time of expense, okay, so we can further elaborate it in a way that during a time period when the expense has been made and when some income has came. Okay, so this is the accrual concept. Then there is a matching concept. In the matching concept, what happens is the expense incurred by an organization must be charged to the income statement in the accounting period in which the revenue to which those expenses related is earned. Like uh, what happens, you have uh, uh, hmm, you have matlab, you have made some expense of 50 rupees. You have bought 50, anything for 50 rupees. Then you are selling that at 70 rupees. Okay, so this happens as per accrual. Clients may pay later or you may pay later. This both be the case. Okay, but what happens in a matching concept, for knowing the actual profit income or net income, we do it within the same year, within the same financial year. Okay, like in the same financial year, we put the revenue, we put the expenses, so we can know the net income. Yeah, it might be the money taking time to come into the account or going out from the account, but for the information purpose, we do a matching of the revenue and the associated expenses with that revenue, and we match them, okay, at same accounting period. Like we made this revenue for in 1920 in a financial year 2019 and 20. So we will put all the associated expenses related to that financial year of 2019 and 20. Okay, so this cost incurred in manufacturing or procurement or inventory is charged to the income statement of the accounting period in which the inventory is sold. Okay, so when it is sold at the same time, the expense has to be incurred. Okay, it is very helpful for the investors, shareholders to know the exact amount of profits and loss the business. So when we do the matching, we do the matching for knowing the actual profit or loss. Then we have some conventions which refers to common practices which are universally followed in recording and presenting the accounting information to business entities. So these are basically the things what are not legally binding, but we have been doing this. So we will keep on following this thing. So there are few points related to these conventions are accounting conventions are guidelines used to help companies determining how to record business transactions, not really fully covered by accounting standards. For some things we don't have specific standards, but we have been doing that in a certain way. Okay. Uh, so these are the conventions. We have been doing it like this, so we will keep on doing like that in the same way in the coming time as well. Like uh, there are some certain examples: FIFO, LIFO, average weighted method. All these are certain examples of this conventions. We will talk further in next slide. And there are some conventions. There are four conventions basically. First is conservatism. In this convention, what happens is we don't anticipate any profit. We put any profit into the account. Once that profit is made, it's not like, yeah, we have anticipated that we are going to have a profit, so we will put into the account. So we will not do that. But in the case of losses, if we have anticipated, we will put that into the account. This is very uh, old technique we have been doing in accounting as an accounting convention. So that's why it's called conservatism. Then on consistency, we will keep on following the same accounting principle uh, uh, over the years. Like we have started with FIFO, then we will keep on to following FIFO. We have been doing the LIFO, then we will be doing the LIFO. Then a full disclosure. Full disclosure means all the monetary events should be mentioned in the all the monetary event should be inserted in a financial statement, generally in the yearly financial statement or daily financial statement, wherever it is required. We have to uh, give each and every details. Okay. Then materiality. Materiality is how important and relevant information is that related to any specific users. Okay. So we all the specific information we have to put in every accounting system. Then one convention, that is GAAP. That is generally accepted accounting principle. GAAP is one of the most asked question in the examinations, and generally abbreviation is being asked that what is GAAP. So you have to mark generally accepted accounting principles. So what is GAAP? In order to maintain uniformity and consistency in accounting reports throughout the world, certain rules and principles have been developed which are generally accepted by the accounting professionals. So these are the gaps. Like we want our account reports should be uniform for over the years, and it should be with consistency that in the same manner how we have been recording, in the same manner we will be recording. So there's the consistency we have been talking about, and for doing it, there are certain rules and principles we have been developed. We have not been standardized or like universal, but those are generally accepted. That's why it is generally accepted accounting principle. Okay? So here are a few examples that are LIFO, that last first in first out. Like for example, I'm giving you. We have about 10 tons of the raw materials in the year, but we have not bought once. We have bought uh, in parts. Like we have started with 3 tons, then 2 tons, then 5 tons. This is how we bought. So, but what we see at the end of year, we find out of 10 tons of raw materials, 2 tons of raw materials are not used. So we will enter that into accounting system for next accounting year. How will we enter the cost of that raw material? So their method, that is FIFO, first in first out. What was the first cost in the financial year when is the first the lot we bought, and what was the cost of per unit? According to that, we will enter this amount in the next financial year of the remaining or the remaining goods that has been left in this year. And then another concept of doing the valuation of the cost valuation of the remaining goods that LIFO. That what was the cost of last lot we have bought. The last lot we have bought at some amount. So according to that, we will put the entry into the next year. Then there is weighted average. We calculate the average amount of the year, and on the basis of that, we do calculate the price of one unit, and then we calculate the total price of the unit that has yet remaining to spend, and we have to uh, put the entry of that into the next uh, accounting or financial year. Okay, so these are three concepts: FIFO, LIFO, and weighted average. Then we have some accounting standards, and there are some institutions nationally and internationally who formulate these standards. And their responsibilities are the accounting standard boards is instructed with the responsibility of formulating standards on significant accounting matters, keeping in view that international developments and legal requirements in India. So this is related to ICAI, that's why it's written in India. But when we are coming to IASC, that International Accounting Standards Committee, which has been set up in 1973, so they do the standardization of accounting worldwide. So they have given the 40 standards, and the body of ICAI, that's ASB, which has been formulated in 1977, has given the standards for India. There are total 29 accounting standards given for the India. Okay, so we have different kinds of like accounting systems. So first is vouchers. Vouchers are the source document, or the vouchers are generally the evidence of any business transactions. We buy laptop, okay, and so there will be some entry regarding that, and that's the basic evidence, and we will get uh, payment slip and warranty card. Those comes under the vouchers. Okay, the vouchers could be of two kinds: cash vouchers and non-cash vouchers. Cash vouchers can be further classified into two parts: debit vouchers and credit vouchers. So, what are the debit vouchers? Debit and credit both are related to cash. So, the debit vouchers are related to purchase and spending made by any organization. And those comes under the debit part, and in the credit part, so what company has earned, that's the income by doing the sale. Those comes under the credit part. Now, non-cash vouchers, they are something like that as well. Those are like transfer or return type things. Generally, today we do a lot of e-commerce buying, like we buy from Flipkart or Amazon type things, where we don't like something, we return back to the provider or the seller. Then we get another receipt for that. That is like return receipt or exchange receipt. So those comes under the non-cash vouchers. So why it is necessary? Because these are related to these can be termed in monetary. These activities are monetary, but immediately no cash is concerned here. That's why this is non-cash voucher. Now we have journals. Journals are the book of accounts in which all day-to-day business transactions are recorded in a chronological order. Okay, so it's very clear from here that how much we have spent, how much we have earned. We will mark an entry of that in a chronological order. So transactions when recorded in general are knowing the entries, and the journal is also called book of original records and book of primary entry. Now, business transactions of financial natures are classified into various categories of accounts such as asset, liabilities, capital, revenue, and expenses. So, the process of this making entry in any journal is uh, being called journalizing. So, when we are doing journalizing, we do the classifying the various category of accounts like we which of the transactions comes under the asset, which are the liabilities transaction, which are the capital, which are related to revenue and expenses. All these are classified when we are doing the journalizing. So each business transactions affect the two accounts. Like I have given you the example of double entry bookkeeping system. That's an example of journalizing. Okay. Ledger. Ledger is an account book that contains various accounts to which various business transactions of business enterprises are posted. So this is also called the business principal book of account. What happens in business? Uh, in an account book, what we do, we maintain the separate sheet for each and every account type. Like we make separate book for asset, we make a separate entry for liabilities, we make separate entry for revenue. So this is how we have categorized the business transactions in seven parts. Those are the asset, liabilities, revenue, expenditures, debtors, creditors, and general ledgers. So all those seven things are uh, the entry of all those happens at separate places. Okay. So and these are some records we keep for the permanent. So for the for analysis and as an evidence as well, we keep it for always. Then we have a cash book. The cash book is a book in which all cash receipt and cash payments are recorded. What we do in the cash only. Okay. So these are recorded here. And if I start with the cash or bank balance in the beginning of the period. Okay. So in the beginning of any business, we so this is the bank balance or the cash we have. So we do the contra entry, that is double entry. One side we do the bank column cash book, another side we simple cash book. That what are the cash being expended and what are and, what are the cash associated with the bank volume. So we make those in the both sides, that is LHS and RHS. Okay. Then we have another. We do another thing in cash book is petty cash book. Petty cash book are made for the small entries like daily spending or the daily requirement in an organization related to maintenance. So those things are entered in petty cash book. So it is called petty because the amount spent here is very small. Okay. Then we have a special purpose book. That's the last. A special purpose book is a form of journal. In general, what happens for a large business organization, it is not possible to generalize each transaction. Thus, journal is subdivided into subsidiary books in which transactions of similar natures are recorded. What we do that we do the returns and exchange. All these are of a specific nature. Okay, and suppose we have not made any specific entry for that any in the general, so we make the special purpose book, that is a subsidiary of general. Okay. So this is how we have almost covered all the basic concepts related to accounting. So we have started with definitions, and after definitions, in the definition we have seen what is the bookkeeping, what is the accounting and the definitions given by different associations. Okay, and then we have analyzed the difference between bookkeeping and accounting. Then we have seen the different types of accounting, like financial accounting, and what are the purposes of those: financial, cost management, tax, social, HR, and national resources. These are the main accounting types. After that, we have analyzed, we have looked into the objective of financial accounting. Why do we do financial accounting? What are the functions and what are the limitations? Okay, and then we dived deeper, and and we have seen each and every term related to any accounting book. Then we have gone through the concept on which we do any accounting entry. Okay. After that, we have seen the accounting conventions, gap model, and the standards of accounting. Then we have seen the different accounting books like journal, special entry, cash book, etc. Okay. So I hope the things are clear to you. And for any further queries and any feedback, you can put me the message, or you can put me a mail on these accounts. These are my LinkedIn, Facebook, and the Gmail. So I will be here with a new video on next Sunday, where we will dive deeper into specific concepts of accounting. So I hope this is enough for this week, and I will appreciate for your feedback and any suggestions. I will. It will be highly recommended for myself that you send me some suggestions. What should be inserted, and if you feel that any topic should be covered in much detail, then you do write me. I will make the specific video related to that. And uh, I hope I have covered all the basic informations related to accounting. Uh, so thank you very much for the session, and we'll meet on the next Sunday. Thank you.